Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to talk about being in the top 1% when it comes to paying off your debt, right? According to ChatGPT. And what is being in the top 1%? Well, paying off your mortgage in under 3 years. So as you can see right here, I paid off my mortgage, lien position one, conventional, no PMI, nothing due. And on this is a screenshot for July 29, 2024. And if you just ask ChatGPT, hey, I paid this off in about 2 years and 9 months, what percentage am I in? And ChatGPT, I've already asked ChatGPT, but let's go ahead and play ChatGPT's response. So you can see right here, I paid my mortgage in 2 years, 9 months. What percentage of people does that put me in?
Paying off a mortgage in such a short time is impressive. While exact statistics can vary by region and the specific demographics surveyed, generally only about 1 to 3% of homeowners pay off their mortgage in under 5 years. Given that you paid off your mortgage in 2 years and 9 months, you would likely be in the top 1% of homeowners regarding mortgage payoff speed. This indicates a strong financial strategy and discipline on your part.
Wow, top 1%. So, yes, strong financial strategy. What financial strategy do I talk about almost every single day in this channel? Oh, I know. It's velocity banking, which we will review again today. Okay, so let's go over velocity banking. What is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account, right? So you just need two things. Number one is a budget that contains all of your debts, right? Income, expenses, and then your expense breakdown has all of your debts. And the last little line here, that's whatever's not debt, right? Things you always have to pay for no matter what. Food, gas, insurance, all that other stuff, et cetera, et cetera. Taxes, right? So if you're paying it once a year, just divide it by 12. It's a simple way of estimating um, how how effective the strategy would be. So, okay, so we have our budget. Now what we need is a line of credit, okay? And so what's a line of credit? All it is a financial tool where you could borrow money, pay back, and then use it over and over again. Now, a lot of people, when they see these demonstrations, they're like, well, who has a line of credit laying around, right? Who has a line of credit laying around like this to do the strategy? And you can't think that way, right? So this is why it's very important to have a good financial foundation before you ever like take on debt, and also understand who do banks lend to, right? I was just recently talking with a nurse, and again, this nurse makes good money. I don't know exactly how much, but every time I say things that I talk about in this channel over and over again, she has like I don't want to say hard time, but but basically it's like the point of view from an average person of how they see banks. In fact, I asked ChatGPT this. Let me go to ChatGPT. Um, where did I ask? So give me one moment to switch. So here you could see like, hey, I asked like, it seems like the average person is surprised by the statement banks don't lend money to people who need it. And this is the most important rule we have to understand about lenders. Lenders are not there to help you. They're there to make money. And what their job is to minimize risk, right? And so I always talk about banks don't lend money to people who need it. And people are like, well, where do you get a line of credit? I say, dude, you you have to get that line of credit before you ever need it, right? But if you had this line of credit at this moment, it would almost be like your lifesaver. And if you have a maxed out line of credit, then you just add a couple of months to your debt payoff strategy, because you're going to pay off your line of credit first, usually, or at least use it as your main operating account. But let's go ahead and play this, right? So let's
It's
play the demonstration.
surprising to many people because the primary role of a bank seems like it should be to help people who need financial assistance. The average person often thinks of banks as institutions designed to offer money to those in need, but banks are ultimately businesses with a focus on minimizing risk. When people discover that banks prioritize profitability and low-risk clients, it feels counterintuitive. Another reason for the surprise is how banks market themselves. They often emphasize community support and financial assistance. So many people expect that banks will cater to those needing a hand up. Only once they go through the loan application process do they realise that banks are looking for a low risk, mutually profitable arrangement rather than providing emergency financial support. This can be a shock for people who, perhaps for the first time, are seeking help only to find out they're not seen as ideal clients.
Wow, that's a great explanation. I don't know if you've ever seen the clip of Family Guy where they parody Chase Bank, right? Like there's a coffee shop, and then there's like, oh, we serve cafe to these type of people, and we serve iced tea to this type of lady, and it's like there's a, you know, they shake your hand and look, I got my laptop. You ever see those commercials or you like that parody in Family Guy? That's exactly how banks portray themselves. Like they emphasize community support and financial assistance, but really they're just profit seeking businesses like any other businesses, right? And so that's why a lot of people don't understand the mindset of who a bank's ideal client is. But a bank's ideal client is someone who does not need money but is somewhat bad at managing it, right? Like I can't emphasize that enough. But even today I was like, yeah, who does a bank serve? People who need money or who don't need money? And the nurse was like, the people who need money. I was like, no, that's absolutely not true. And here's the thing. So that's how you kind of be the top 1% as well, is you kind of have to know what your opponent or slash enemy is thinking. Although I don't really think of a bank as my enemy, they have the tools that I need in order to do like, real estate deals and all that. And so my point is this: if you want a line of credit, get it before you need it, right? And so if you want to know how I got all these lines of credit, I have over $527,000 in lines of credit. It'll probably be a million soon. I don't know when. But I have much more than I need. And right now I don't need the money. That's why it's the perfect time to get it, right? People don't understand that. People, they're like, well, just like a ChatGPT says, like it's a shock when people go to a bank, they need the money, and then the bank rejects them and they're not seen as an ideal client because people who need money carry too much risk. Very important to know that. But what if you did have a line of credit? And what if you had made great income and you had zero, like an insane amount of expenses from credit card debt, and you had one penny left over? Now, just because you have a line of credit does not mean it's velocity banking. Because if you did this, let's say you had a $3,000 car emergency, charged it to your line of credit, right? And then guess what? Now you just have an extra $50 minimum payment. And now you're in negative savings. That's how the average American pays for things. They use their checking account to pay for things. What we're going to do is we're going to move some debt into the line of credit. And whenever we get paid, right? Whenever we get paid, all our money leaves our checking and savings and it gets dumped into that line of credit. That's what we mean when we say using our line of credit as our main operating account. That's what we mean, okay? So now let's go ahead and do this and copy some of these expenses. And if you've seen this presentation before, hey, practice makes perfect, right? Do it over and over and over again, like I'm doing. And that's how you become the top 1%. See, the top 1% is just doing the work over and over again, not just being like, oh, I understand now, so I don't need to practice. And there's that saying, hey, amateurs practice until they get it right, professionals practice until they can't get it wrong. And even though I paid off my mortgage in 3 years, I'm just still doing it over and over again, little by little, every single day, right? That's how we learn as human beings. We don't learn well in all-nighters, right? You ever notice that the average college student is like, I'm going to pull an all-nighter, and then they don't remember, even if they get an A on a test, they don't remember anything that they learned. Well, I'm not pulling an all-nighter. That's how I'm going to be. I'm going to be at the top 1%. I'm going to stay at the top 1%. Okay? So now let's go ahead and do this. We're not going to have any savings, which is kind of like the whole basis of velocity banking, of dumping all your money. And your line of credit is kind of like your tool to have access to your money and be able to pay off all your debt at the same time, right? Whereas if you dump all your money directly into loans and even credit cards, like let's say I overpay a credit card, you can't directly get cash out back. It's a little bit more difficult, even though a credit card is technically a line of credit. So let's go ahead and do this. Let's go ahead and move these 10 credit cards into that line of credit, and this is $167,000 in credit cards, right? $167,000 in credit cards. Okay, well, what happens here? Simply by moving these credit cards into that line of credit, all of these payments just magically go to zero, and people have a hard time like understanding this, but there's one more step, is that once we move that debt, the way that we make it our main operating account is that when we get paid, this all of this money gets goes into the line of credit. So there's a button on the website, make a payment. What you do is you make the minimum payment in addition of putting your entire paycheck into that line of credit. So in essence, it would be an overpayment, right? Okay. So now let's go ahead and do this. And then what we're going to do is we're going to take the next month's balance, which is the previous month's balance minus the previous month's interest. And then we get this number here, 5345.84. And then we get the next month, okay? And then what we're going to do is we're going to take the average daily balance right here. And now I'm going to do this, right? And then what we're going to do is we're going to take the interest rate, and we'll say it's 10%, even though my interest rate is actually 8% on the home equity line of credit. But no biggie, because we're dumping all of our money into debt, and we're going to take our most inefficient debts, which is the ones that suck up the most cash flow. And it's correlated with high interest rates, but it's not always the highest interest rate. And then we just keep going and going and going. And then we see here, right, that in um, 37 months, whoa, it's paid off, right? It's totally paid off in 37 months. I am so proud of this fake person who was in one penny left over in savings. And remember, okay, think about mainstream financial advice. What does Dave Ramsey, the most popular financial guru, tell you to do? Save $1,000. Now, you think it's possible for the average person to save $1,000 when they're in this situation? Probably not. Okay, so let's go ahead and do this and write 37 months to wipe out that $167,000 of credit card debt, and then we're just going to go into here, and then now we're going to make it easy today. We're just going to pay off this $300,000 mortgage. Now, if we're making $9,000 a month, I might be a little bit more fancier and get like a $400,000 or $500,000 home. But you know what? A $300,000 home is pretty sweet in the right area too. In fact, my home is kind of in one of those areas. It's like a new construction build, and I remember like reading like or watching all these YouTube videos like the dangers of new construction, and then I still bought it anyways because like, oh, it's a decent neighborhood. And what's funny is that they have like this 1 year period where the builder will actually come in and then like look if there are any defects in the home, and then they actually went in and said, this home has no defects, unlike the other homes. I'm like, whoa, I scored the big jackpot, didn't I? But anyways, so let me go back and to what I was talking about, which is that now we got to update the balance of the loan. So I have a loan calculator somewhere here. So actually, I've been doing this. So give me 1 second. So instead of, this is from another demo, right? Another demo. Let's just do this. Let's update these numbers so you can see in real time how it would be done to figure out the loan payment and all that good stuff. So $300,000 is the original balance. And then this is the payment amount. Is it 300,000? Hold on. Yeah, 1264.81. That's how we get that. And then what's the current month right now? Yeah, it's 37 months, right? And then you could see how much interest we paid and what the current balance is, 280,000. And now at this time, this is where I would do what we call the chunking method. So there's two ways that we can pay off the balance of the loan, right? If we're going to apply all our money to debt. Number one, we could stop using a line of credit, right? Now, should we use a line of credit, especially at a 10% interest rate when we could put 0% money into the mortgage? Well, it depends, right? It depends. And this is how I think of it, okay? So, you know how like gym memberships are incredibly cheap at like the beginning of New Year's, but the gym doesn't actually expect you to go to the gym? It's kind of the same deal with mortgages. There's a reason why this mortgage is so cheap compared to a line of credit, right? 3%. Why is that? Well, it's because you only have one-way access to your money, and the interest rate really represents two things. Number one, the amount of risk that you carry for the lender, and then number two, how much access you have to your money. So think of it like software features in like maybe a SaaS product where they got the free version where you only get three features available, and then you got the paid version and they might have like 10 features available. Okay, so the reason why this line of credit is 10% is because you have unlimited two-way access. Whereas with the loan, if I dump my entire paycheck, my entire cash flow directly into the loan, am I able to get that money back? No, I can't. And once you do that, right, then let's say you use these credit cards as backup, you're going to segregate your income. And that's what's caused the confusion in the first place to be here, right? We do not want to segregate our income. So the way that I want you to think about this is that if we use the default option, so default option is kind of like, you know, everybody can do this, extra payment to the loan, okay? You know what this is like? This is like a Netflix account that you can only watch from, let's say, 1 a.m. to 6 a.m. Why? Because your access is limited, right? If you make an extra payment to the loan, this will cause your income to be segregated and it will limit access to your money, okay? Number two, the second option is you still use your line of credit as the main operating account. So what we are going to do is just move a little piece of that mortgage into that line of credit and just dump all of our money in there and then do it over and over again. And the way that I kind of think about this, and this is, I probably should just move this here. So I'll say this is like Netflix, 1 a.m. 1 a.m. to 6 a.m. access only, and it costs like, I don't know, something really cheap, like $1 a month. Okay, but even, just like I said, it's like one of those gym memberships at the end of the year where they offer the discount and they don't expect you to go. It's the same thing here, right? You have limited access. Now what I want you to do is kind of think of it like this, where you would have a Netflix membership and then you could pay anytime, or I'm sorry, no, use it anytime, right? Anytime. Use it anytime. And we'll say it's this, maybe like $1, 5 cents, 10 cents a month. Okay. So which one are you going to use? Are you going to use the option where everybody has it and nobody uses it, which is the default option of extra payment to the loan? Or are you going to actually do it because now you've moved some of your principal to your line of credit? You made it easy for you, and making it easy for you has a lot of value. That has a lot of value in our society, believe it or not. And if I could just use all of my money whenever I want and dump all my paycheck and have my paycheck, I'm sorry, cash flow eliminate the principal of the debt, then why wouldn't I do this? Like, what the value of a strategy is if you're actually going to do it. And most people like always talk about this option, and I'm like, who's going to watch Netflix from 1 a.m. to 6 a.m.? Like, nobody. Yeah, even though it's the cheapest option, I'm never going to use it. Same thing with overpaying a loan directly. Nobody ever does it. Almost nobody, right? Very few people. Okay, so let's go ahead and just kind of do this and move some of this principal into that line of credit. So we could just do maybe like $10,000 chunks. Okay, so let me just go back here, and I think this is 37 months. And so if I just, this would be like 270. Now let's just do a quick comparison. How long does it take to pay off maybe $10,000, and how much have we paid off in about 3 years? It's about 20 grand. Let's just do this. Okay, so in 37 months we paid off about 20 grand. Now, how long is it going to take to pay off 20 grand of principal right here? So we'll just do this, plus 20,000, right? And let's mark it right here, highlight it here, and then wablam, 3, 4, 5, 6. Okay, so how many months was that? So it's like 1, 2, 3. Wait a minute. Something is wrong. Did I screw up? No, I'm in the wrong sheet. What am I doing? Okay, sorry about that. I've done these so many times now. I'm like confusing myself with multiple sheets. Okay, so let's do that right here. So plus $20,000. Okay, because that's the amount that we paid off in this loan here after 37 months. And you take a look here. Oh my goodness, how long did it take to pay off that 20 grand? 1, 2, 3 months. So we basically shrunk 36 months into three. Wow, that was so easy. And look at how much interest we paid to help us do that in that line of credit. It is so minimal, right? It is so minimal. and take a look at the potential savings right here. If we'd done this from the beginning, and I'm not saying we'd be able to do this in the beginning because the mortgage is the last loan that we pay off, we could have potentially saved 26 grand just by doing this one little chunk and paying, I don't know, 100 something, maybe $200 of interest, right? So, and also we're actually attacking a little bit more the principal of the loan and also paying some interest because we still got to make the monthly payment. But my point is this, right? Too many people over focus on this mortgage part because they're just kind of comparing green apples to red apples, right? My point is this: the reason why I like using the quote chunking strategy is because it makes it easy for me to do what I'm supposed to do, which is pay off my mortgage. Too many people, they feel uneasy about paying off their mortgage because they can't get rid of the notion that they're going to have any savings. And so when they put their entire cash flow into that mortgage as a direct extra payment, then there in their mind, and although this is not technically true, when you have credit, lots of lines of credit, their mind that money is gone, right? So let's figure out how long is it going to take to pay off that loan, and we'll just do that right here. So give me 1 second to fill in the information, and you know what? I'll just fill it in front of your eyes with this Velocity Banking Calculator by Renatus, and I'm a what I call independent contracted marketer, meaning I'm a salesman for Renatus products because this is where I originally learned velocity banking from and all this other cool stuff. Now, here's the thing: I probably got to do these like webinars because I probably am terrible at selling this, and I'll tell you why. It's because my life is a little bit too comfortable. And so when you have too much money, you're kind of a terrible salesman, to be honest with you. All right, well, let's go ahead and do this. So let's put in those numbers. So it's 300,000 at 3%. And then what's the payment here? The payment is 1264.181, 1264.81. And then, now let's go ahead and do this. It's 280,069.25. 280,069.25. Okay, and then what is our line of credit? It's 10%. Whoopsie. And then what we're going to do, so let's put in the right income. And because we're balling today, what's our income? It's 9110.65. 9110.65. And then what's our expenses? Yeah, 2,500. Okay, so all right, so let's take a look here. Now, the thing that I want to really warn you about is you don't need what we call a first lien HELOC replacement. So some people on the internet were like, "Oh, loan bad, line of credit always good." But if we replace our loan, wait, did I do okay? Loan with, let's say, a 10% line of credit. Okay, let's see what happens here. Take a look at this. Now, this looks impressive. 4.4 years. Let me write this down. And 67K of interest, okay? But if we just do it in small chunks, and we'll just say like $10,000 chunks, take a look at this. It's 3.8 years and 17K of interest. Now, would you want to spend more time and money to pay the bank, even though you're accelerating it by $50,000? I mean, here's the thing: if you want to pay $50,000 more to the bank, don't do that. Just give it to me, right? You can just write me a check, and I do have a Stripe account, even though I never really used it. So if you want to Stripe me that $50,000 instead of to the bank, I'd really appreciate it because if you do that, I probably will get a Tesla, and I talk about that all the time. But my point is this: you don't need to do a first lien HELOC. Everybody like promotes on the internet for some reason, and it might be because of they get some kickbacks, commissions. I don't know. I get some commissions too. Nothing wrong with selling products, but what I'm saying is that you want to sell the right product to the right person, right? You don't want to just kind of aimlessly promote something that doesn't make sense. Like if you have an 8% mortgage, which I do, I've done the math with replacing with the 8% HELOC. It works out pretty well. But, okay, but if you got like a 3% mortgage and you replace it, it's like almost unnecessary. Okay, it's almost unnecessary. All right, so that's it for today. So let me actually go back to the other spreadsheet. So this is going to be this, and then it's going to be 37 divided by 12 plus 3.8, and then this is going to be 6.88 years. Ooh, we are debt free. We are debt free. And you know what's funny? Okay, we paid the mortgage off in 3.8 years, and I haven't done a simulation at all where we paid it off in under 3 or 2 years and 9 months. So it must be like kind of like, I don't want to say obvious, but kind of clear that paying it off in the time that I did is totally not natural, right? So because even in the best situations where you're making all this income, the best scenario is like 3 years and something months, right? I paid it off in 2 years and 9 months. So it should tell you whether if I'm rich or not, or possibly a cult leader, or possibly did I just make up these screenshots, kind of like those Instagram teenagers who rent out Lambos and like, hey, take a look at me, I'm a success, and then just they got to return those rented Lambos, just like some of those gurus who rent mansions, like, well, I'm so successful, and then it's like you read in the news they foreclosed on their, or evicted them from their rented mansions. Maybe that's me. I don't know. Okay, I could be a lot of things. I mean, I'm on the internet, right? But here's the thing: just from this screenshot, I don't even have to brag. You already know I'm in the top 1%. ChatGPT knows I'm in the top 1%. And this is how you be in the top 1%. You just pay off debt quickly, and velocity banking is a strategy to help you do that. Oh my goodness. And now, if I type in zero right here, what's my new cash flow? My new cash flow, 6 grand a month. Ooh, 6 grand a month. Wow, that's really good. Whoa. Okay. All right. Well, that's it for today, everybody. This is about, let me know if you're in the top 1%. And hey, even if you're in the top 1% right now, just let me know if you're aspiring to be in the top 1%, right? Write in the comments. Just say, I want to be in the top 1%, or tell me I am in top 1%, right? There's only two answers, and both of them are correct. I want to be in the top 1%, or I'm already in there, right? I'm already in there. Okay. Okay. Well, it's Korean Atlanta Mentorship. Have a great day, and we will speak next time.